Moving from the US to the UK is a common step, but it immediately throws you into the complex world of international tax obligations. Uniquely, Americans face the challenge of being taxed on their worldwide income, no matter where they actually reside, which is rare globally. Even after settling in the UK, you still have to keep filing those US tax returns and potentially pay us taxes on your foreign earnings. However, this complexity also unlocks some significant and unique tax-saving opportunities, if you know how to navigate the system. By understanding the intersection of the US and UK tax rules, credits, and treaties, you can strategically optimize your tax situation. The key to true efficiency is proactive planning, recognizing how both tax systems interact thoroughly before you make a major move. The entire foundation for your planning rests squarely on the official US-UK tax treaty, designed to prevent double taxation. This important agreement establishes clear, tiebreaker rules to decide which country gets the primary right to tax different types of income, like salary or pensions. Critically, Article 24 addresses eliminating double taxation, usually by giving the US a foreign tax credit for taxes already paid to the UK government. You must also know about the US Saving Clause, which generally preserves the US right to tax its citizens, but comes with specific exceptions that create planning room. Understanding how the treaty handles specific assets, like capital gains on property versus other investments, is essential for accurate compliance. Furthermore, provisions regarding Social Security and government pensions dictate where those specific retirement payments will ultimately be taxed. Your first major defense against double taxation is the powerful Foreign Earned Income Exclusion, or FEI. This rule lets qualifying individuals exclude a substantial amount of their foreign salary or self-employment income from US tax liability each year. For instance, in the 2024 tax year, that exclusion limit works out to over $126,000 for a single person. Remember, this only applies to earned income, meaning passive income like dividends, interest, or capital gains doesn't qualify for this exclusion. To claim this benefit, you must satisfy either the physical presence test or the much more subjective bona fide residence test. The physical presence test is a simple day count, requiring you to be outside the US for at least 330 full days within any 12-month period. This physical test offers great flexibility, allowing you to align your qualifying period with your specific move date rather than the calendar year. Alternatively, the bona fide residence test demands you establish a genuine, long-term, uninterrupted connection to the UK for an entire tax year. Factors like buying a house, registering locally, and moving your family all demonstrate that intent needed for bona fide residence. The advantage of bona fide residence is that once you qualify for a full year, you can often claim a partial exclusion for the start and end years too. To actually claim the exclusion, you must meticulously complete and file the necessary Form 2555, along with your annual US tax return. While the fee excludes income, the Foreign Tax Credit, or FTC, offers an alternative by reducing your US tax bill dollar for dollar, based on UK taxes you already paid. The choice between fee and FTC hinges entirely on which tax system has the higher effective rate on your specific income level. Since UK income tax brackets are often higher than comparable US federal rates, especially in the middle income range, the FTC frequently becomes the superior choice. If your UK tax liability is higher than what you would owe the IRS, the FTC can eliminate your US tax entirely, often creating excess credits you can use later. You should consider the FTC over the FEI when earning significantly above the exclusion limit, or when your foreign tax rate is already higher than the US rate. However, the fee is better if your foreign tax rate is significantly lower than the US rate, or if you have many deductions that the FTC might otherwise render useless. Many savvy expats use a hybrid strategy, applying the FEI to the first chunk of earned income, and then utilizing the FTC for everything above that amount, plus any passive income. Regardless of your choice, the calculation involves complex rules found on Form 1116, which categorizes your income into different baskets. Remember, you cannot claim both the FEI and the FTC on the exact same dollar of income, so you must make a conscious election for the tax year. Knowing exactly when you become a UK tax resident is vital, because that's when UK tax obligations on worldwide income begin. The UK uses the Statutory Residence Test, or SRT, a three-part framework to determine your official residency status each tax year. The first stage involves automatic overseas tests, which, if met, instantly confirm you are finna to not to, a UK resident for that year. If you fail those, you move to the automatic residence tests, where spending 183 days or more in the UK typically makes you a resident. If neither automatic test applies, you must then navigate the Sufficient Ties test, which looks at factors like family, home, and work connections to the UK. Fortunately, the concept of split-year treatment can be a massive advantage, effectively treating your tax year as two separate periods. This allows you to be taxed on worldwide income only from the day you officially establish UK residency, not from the 1st of January. For someone moving to the UK, qualifying for split-year treatment means you only become subject to UK worldwide taxation from your arrival date onward. Understanding the UK tax year runs from the 6th of April to the 5th of April. Distinct from the US calendar year, allows for precise strategic timing of your move. For us expats who are not UK domiciled, the remittance basis of taxation represents perhaps the most powerful shelter for foreign wealth. Domicile is a complex legal concept different from residence. Most Americans retain a US domicile of origin, even after living in the UK for years. Under the standard arising basis, the UK taxes all your worldwide income, but the remittance basis lets you avoid UK tax on foreign income you don't bring into the UK. This means that investment income, rental earnings, or capital gains from US assets can entirely escape UK tax as long as you leave them parked overseas. However, this benefit isn't entirely free. After the first 7 years of residency, you might have to pay an annual remittance basis charge starting at £30,000. To decide if it is worth it, you must compare the RBC amount against the substantial UK tax you would otherwise pay on those shielded foreign earnings. Strategic financial structuring is key. You must keep foreign income in segregated overseas accounts, separate from your clean capital accumulated before moving. When funding UK living expenses, always use that clean capital or UK source income first to avoid accidentally triggering a taxable remittance from your sheltered foreign funds. Crucially, the remittance basis has no impact on your US tax obligation, as you still owe the IRS tax on your entire worldwide income annually. The UK offers tax-advantaged savings vehicles like ISAs, but utilizing them as a US person requires navigating significant reporting hurdles. An ISA allows UK residents to grow investments tax-free within the UK system, with annual contribution limits around £20,000. The major problem is that the US does not recognize ISA tax advantages, meaning you must report all ISA interest and gains on your US return. US tax treatment. The US-UK tax treaty provides that UK pension contributions are generally deductible for US tax purposes, up to certain limits. Article 17(2) of the treaty allows contributions to be deducted as if the pension were a US qualified plan, subject to limitations. However, the rules are complex. Contributions must be to a pension. Worse still, ISAs holding pooled funds are often classified as passive foreign investment companies, triggering punitive US tax reporting like Form 8621. To use them safely, consider cash ISAs or holding only individual stocks and bonds to avoid that complex PFE classification entirely. UK pension schemes, conversely, generally receive much more favorable recognition from the US under the terms of the tax treaty. Individual savings accounts, ESAs, are tax-advantaged investment accounts that allow UK residents to save and invest without paying UK tax on the income or gains generated within the account. For the 2024-25 tax year, the annual ESA allowance is £20,000, meaning you can contribute up to this amount across all your ISAs in a single tax year. Employer and employee contributions to recognized UK pensions can qualify for tax relief in the UK and often a corresponding deduction on your US return, up to certain limits. Like a US 401, investment growth inside these qualifying pensions is generally tax-deferred in both countries, making them a superior option to ISAs for long-term savings. UK tax advantage accounts, ISAs, and pensions. The UK offers several tax-advantaged savings vehicles that can provide significant benefits to us expats, though the interaction with US tax law requires careful consideration. Maximizing these pension contributions is a smart strategy that leverages the tax benefits of both the UK and US systems simultaneously. Interaction with US taxes. The remittance basis doesn't affect your US tax obligations. You still owe us tax on worldwide income. However, it can affect your foreign tax credit planning. If you don't pay UK tax on foreign income because you are using the remittance basis, you won't generate like, comment, share, and subscribe for more financial tips.